Well, good morning, everybody. Thanks, everyone, for being here, for spending your Friday morning with us. It was great to see many of you yesterday at our breakfast, where we heard from Ryan Avery. Thank you for joining us today in our 33rd installment of our EO Exchange series. I can't believe there's been 33 of them. That's so cool. Today, we're focusing on financial strategies during rising rates. We're excited to be with our strategic alliance partners, Continuum Planning Partners and Pinnacle. We've set aside some time in the back half of this meeting for Q&A. So as you have questions, feel free to drop them in the chat or make note of them so we can circle back and have some discussion points at the end. And for now, I will introduce our wonderful panel who will be speaking this morning. First will be Kevin Roddy, a longtime strategic alliance partner. He's a senior VP at Pinnacle, currently serving in our community on the board of the Entrepreneur Center as treasurer and the board of Family and Children Services. In addition to past service on numerous boards, Kevin was a past board chair of both Friends of Warner Parks and Big Brother, Big Sister of Middle Tennessee. He's a native of Memphis, a graduate of W&L with an MBA from Owen Graduate School at Vanderbilt University. We'll then hear from Mac Johnston, who does economic and interest rate forecasting for Pinnacle. Prior to joining Pinnacle, Mac was with Morgan Stanley, and before that, spent 13 years at Payne Weber, working in New York extensively with capital markets. Mac holds his bachelor's from Southern Methodist University and a master's in finance from Columbia. And finally, Andy Fott is known to many of us. He's with Continuum Planning Partners and has been a financial planner since 1999. Graduating magna cum laude from Lipscomb University, Andy majored in finance, economics, and accounting. He's married to Jennifer, involved with the Martha O'Brien Center, and a member of the board of directors for East End Prep School, a charter school in East Nashville. With that, I'm happy to turn the time over to Kevin. And reminder, drop your questions in the chat or make note of them for Q&A in the back half of this meeting.
Thank you, Brandon. Good morning. I really appreciate the opportunity to be here and speak to y'all remotely and go through this, presentation with the help of my friends from Continuum about strategies in a rising interest rate environment. As we thought about this presentation, at least from my standpoint, thought it'd be helpful to just talk about where we are in both the interest rate cycle as well as the economic cycle, sort of how we got here, where we are right now, and what we expect going forward. So to do that, I asked my friend and colleague Mac Johnston to join us. Mac is basically the chief economist for Pinnacle Financial Partners for the entire firm, and he does a great job of giving a good executive summary of the economy, what we expect from a rate standpoint, and how it affects both us as a bank as well as our clients, which we're fortunate enough to call many of you our clients as well as our friends. And after he goes through that, I'll talk a little bit about how we see things here in Nashville and what it means from a banking standpoint, and then I'll turn it over to Andy and Abby, who will share with you, more specific strategies as it relates to this interest rate environment. So with that said, Mac, I'm going to hand this off to you and see if I can stand by here, see if I can share the screen. One second. It was easier said than done.
They didn't teach Zoom at Owen?
I'm still, the return on that investment is, I'm still waiting for it, put it that way. And here we go, Stan. All right, yeah, there you go. All right, my work is done here. All right, Mac, I'm going to let you, I'll go through the slides, so just cue me when I need to switch slides. So I'll start.
Let's start on the third slide, the summary page.
Right here?
All right, Perfect. All right. Good morning. Glad to be here. I'm going to talk briefly about 5-7 minutes. I've got 13 slides. I'll be brief. If anybody has questions, we can cover that at the end. You know, the Fed's on pace to raise rates 300 to 350 basis points this year. There've been 5 meetings so far this year. Currently, Fed funds is 225 to 250. In a normal rate cycle, the Fed would raise, since World War II, 300 basis points. They'll raise the full 300 basis points between March and September. And then the Fed has an tendency to over tighten rates. If you looked since World War II, there have been 14 tightening cycles, including this one, 10 of which those cycles they over tightened and were cutting rates 12 to 24 months later. And I think we're in the same boat there as we are today. And I'll talk about where the bond market is and sort of how I see the difference between what the bond market's currently forecasting. And then finally, I think the US economy will likely see a recession from over tightening. You know, it's too bad the Fed didn't start tightening last year, and they were doing quantitative easing all of last year and even to March of this year. If they'd started sooner, their job would be a lot easier, and I don't think inflation would be as robust and persistent as it is. And then finally, at this point, I see the risk of recession about 2/3%, risk of a soft landing at 1/3. You know, when you look at a recession, you get a number of indicators that are out there that you normally get with all recessions. That'd be falling GDP, which we have currently. You've got an inversion of the yield curve. You've got home prices and home sales falling, retail sales falling. And the one thing we don't have at this point is the unemployment rate rising, and I'll get to those numbers. And then the Trump administration spent about $2.5 trillion. The Biden administration spent about $3.5 trillion in fiscal stimulus. And so the deficits today are much higher than they've been at any time in US history. And what I think that means for us as we move forward is that growth is going to be slower. And I'll get to that as we go to the detail. Next slide, Kevin. This is a index, sort of a Bloomberg dollar index. I think it's important to look at it. You know, our Federal Reserve is the most aggressive Federal Reserve in the world. So the dollar is rallied against all major currencies. We're roughly at parity with the euro. This, you know, short 300 basis point rise in rates in the 6-month period from March to June is going to mean that, you know, as our Fed continues to hike rates to get inflation back down to their 2% core target, you're going to see other currencies depreciating relative to the dollar. You're going to see commodity prices depreciating relative to the dollar. We've already seen oil prices go from 130 to, you know, $93. We've seen lumber prices at a 40-year low, copper prices roll over. And so just remember, as long as the Fed stays on the gas pedal, the dollar will remain very robust versus other currencies and commodities. And the impact will be that it'll help slow our economy down because it'll hurt exports. Next slide. This is the GDP forecast. If you went back to the pandemic, you know, the economy shrank in 2020 by 3.5%. We grew at 5.6% in last year. If you were to look at like fourth quarter GDP last year, it was 6.9%. It was the best number of the year. And then first quarter was a -1.6. So huge deceleration. And then I think it's very unfortunate that the Fed waited so long to start tightening rates. From here, you know, we're sort of in a paradox from an economic standpoint. We have flat to negative GDP rates, but record low unemployment rates. And as I said, I think over time, we'll get the unemployment rates to go up. I'm not very optimistic about where growth is going to be. I would tell you that street numbers for next year for 2023 are generally in the 0.3 to 0 area. And so I think we'll remain sort of bumping along the bottom on GDP for the balance of this year and at least the first half of next year. Next slide. If you look at the unemployment rate, you know, the unemployment rate in December of 2019 was 3.5%. In April of 2020, after the pandemic, it peaked at 14.7%. We've now done a round trip. July unemployment, the unemployment rate was 3.5%. So, you know, the fiscal stimulus and the QE was successful in getting the unemployment rate back down, but you still have a labor force that's not fully engaged. If you look at underemployment rates and people in the workforce, you've got to still have a lot of people that are out of the workforce. And I don't think COVID's the excuse anymore. I think some people just didn't like the life they had prior and will not enter the workforce unless they get a better job. And so I expect the unemployment rate to rise to over 4.5% by the middle of next year. And we'll get an unemployment rate release on September 5th. That's the next time we'll see it. I would expect it to move up at least 0.1 to 3.6. Next slide, Kevin. This is the money supply. I think what's here, this is M2, includes all bank deposits and all money market mutual funds. What's important here on the right axis, you can see in 2020, by doing all the QE, 4.8 trillion of QE and 5.3 in a quantitative easing, you took your money supply up by almost 48%. So you had an asset bubble, real estate prices, stock prices, house prices all rose, and a wealth effect. I think that will slowly unwind over the next year or two. And we've seen sort of volatility in the stock market. And at this point, I think home prices could fall 10% from where they are today. Next slide, Kevin. This is a PPI. PPI in 2020, we deflation was a big fear. As I said, you injected, if you looked at 2019 GDP, it was $21.4 trillion. Between QE and fiscal stimulus, injected over $10 trillion. So you brought a lot of growth forward. You create a lot of inflation. I think the inflation will fade as the economy continues to slow. And eventually, I think the Fed's goal is to get the unemployment rate up and for consumer spending to slow, which represents about 70% of the GDP. But right now, we got a week ago, we got July PPI, it came in 10.4. It was down from 11.2. Export energy at 7.6. Again, inflation's running 3 times the Fed's 2% target. We've had a bunch of Fed governors come out in the last day or so saying we need a bigger rate hike for September 21st. I think that's probably on the table, but it's data dependent, and I'll get to that slide. Next. This is the yield curve. The gold line is where we were at the beginning of the year. The blue line is where we are today. Currently, the yield curve today is inverted about 29 basis points from 2 to 10 years. A month ago, it was at 22 basis points. I think what the story is here is this is a classical indicator of a recession. Typically, when you get an inverted yield curve, you get a recession between 12 to 18 months later. I think it's still in the cards to have this recession and have the unemployment rate rise, as I said, probably in the first half of next year, which is when the Bureau of Economic Analysis will declare it's a recession, even though the Biden administration might disagree. So you've got an inverted yield curve. I think the Fed's got at least 100 basis points, maybe another 125 basis points to go in hiking. I think the question mark between analysts that believe the Fed's at a pivot point, and I can talk about that when we get to the Fed funds, or the people that think that the Fed will keep hiking in the next year. I think that's the debate on how much they'll really hike in the first half of next year. Next slide. This is the current Fed fund futures. If you look at this third column out, you can see the number of hikes right now is 253%. So one hike is 100%, 2 hikes is 200, 3 hikes is 300%. So right now the September hike is the futures show right in between sort of 50 and a 75 basis point hike. And then on top of that, you'll see probably the possibility of 225 basis point hikes in November, December. The Fed fund futures are already forecasting that the Fed will be cutting rates in the second half of next year. I think there's a disconnect between what the Fed is saying and what the bond market hopes. I believe that even if the Fed only raises rates once or twice early next year, and so Fed funds end at 4%, that they'll pause for 4 to 6 months. And so they're not going to go immediately from hiking rates to cutting rates. And so you'll have this pause. And I think the impact of that will be that you'll really feel the slowdown. When the Fed started raising rates in March, and then they accelerated their hikes, there's a big lag between when the Fed moves rates and when you really feel it in the economy. I think as we get into September and October, you'll really feel the slowdown. And so, and they've really started, and plus they've started quantitative tightening in June. They're selling 47.5 billion of bonds a month. Next month in September, they're going to 95 billion a month. I think when we get into January, they'll accelerate those sales, which will have a market impact on asset prices. And I think asset prices will stay under the thumb of the Fed as we move forward. Next slide. This is a view of the 10-year Treasury yield. The 10-year Treasury yield is a great indicator about where the economy is going. At the height of the pandemic, the 10-year Treasury yield got all the way down to 50 basis points. We peaked at 349 a month and a half ago. We've been as low as 240, 255. We're currently in the 295 area, going back above 3%. I think the reason for that is the Fed seems to be more data dependent and not so gung-ho on hiking rates just to hike rates. And so the probability of a soft landing has increased. If you'd asked me a month ago what I thought the probability of a soft landing was under 25%. So I think the Fed is probably doing a better job, and they've gotten back a lot of credibility as they've been aggressive, and you've seen the dollar rise, and they're clearly in control now, which they weren't in control of inflation 6 months ago. Next slide. This looks at the spread between the 2-year Treasury and the 10-year Treasury through time, and what that spread is. Again, you can see these negative numbers below the bar, whereas when you have an inverted yield curve, past recessions are in the gray bars. So, I mean, you've got, if you went back and looked at these past periods where you got an inverted yield curve, you always got a recession. It's 100% indicator of recession. As I said, you're inverted by 29 basis points. A week ago, you were inverted by 44 basis points. So, you've got 4 or 5 indicators of a recession, but you still have record low GDP unemployment rates, which I think will get solved as we move forward. Next slide. This is a Case-Shiller home price index. We've had 2 consecutive months of home prices falling. As I said, with the increase in the money supply, we had this, big wealth effect and asset bubble. I think home prices have to fall from here. I think the dynamics of single family homes, the market is still going to be robust. There'll continue to be demand because a lot of people, as we'll get to this next slide in a second, a lot of people are being priced out of single family homes because they can't afford the starter home. And they're being forced to rent in multifamily units or single family homes for longer. And that's unfortunate. If you go to the next slide, Kevin. Sort of ties into this. This is US single family home inventories going back 35 years. You can see when the 08-09 financial crisis, when Fannie and Freddie about went bankrupt and the US government had to rescue them, they tightened underwriting standards. There was no more stated income. All mortgages are full documentation now. So a lot of people can't get through the gauntlet of that. So what's that mean is that inventories are very, very low and prices are very, very high, and you have a shortage of single family housing. So while I think in the short term, home prices continue to fall, maybe 7 to 10% nationally, I think that's the fall here in Tennessee, or especially Nashville, it probably is 5 to 7% max, because we have so much population growth pushing up on prices. And then the next slide. I threw this slide in here. This is a chart of reformulated oxygenated gasoline. This is generic gasoline that's traded on the open market, and then the different companies like Exxon put their own additive package in it. During the pandemic, the refiners took about almost 6% of refiners offline because there was lots of slack in demand. Now that demand is back for gasoline, we've seen record prices. The last spike we had was in 2008. The Russia, invasion of Ukraine, caused about 12% of that Russian oil to come off our market, and a lot of that was going into gasoline. So we've seen a big disconnect. Typically, there was about a 87% correlation between crude prices and gasoline prices. We've seen a total disconnect there. As I said, crude oil prices are down over 30%. I think gasoline prices will continue to slow as the economy slows. We saw in May that during the spike that U.S. retail pump gallons sold went down 8% as people got more efficient in their driving or parked the cars. We saw that same number in June where gallons dropped 5%. So I think that people are becoming more efficient. People are thinking about their trips, and gasoline will continue to fall back down. But I don't know if it'll get to where it was before the Ukrainian crisis. And that's all I've really got. So to sort of tie it together, you've got a number of classical indicators for a recession. You've got falling GDP, this curve inversion, home prices down, home sales down, retail sales down. And the last thing we're waiting for, or the last shoe to drop, would be a rise in the unemployment rate in falling consumer spending. And I think when we get that, we'll have a recession. At this point, I would think that'd be sometime between the fourth quarter of this year and the second quarter of next year. Thank you.
I'll go through my portion real quick, and then we'll stop, see if there are any questions. But I guess after Mac's comments, what does all this mean for us here in Nashville? And we know anecdotally we continue to grow. This is in looking forward, that growth will continue. This is a shot that I'm sure many of you have seen, shamelessly screen scrape from Channel 4 one day on a day where Lebanon looks like they have a particularly crappy weather forecast. But anyway, this is a shot showing the buildings that have been constructed in the downtown, midtown area, those that have been planned but delayed, and then those that are under construction. So we can see that growth is projected to continue. There will be a lot of people coming to this market that will fill these buildings. But is that a flash in the pan? Is there going to be, what is the historic growth of Nashville look like during periods, particularly challenging periods in the economy? Colliers had a presentation or a program about 2 weeks ago where they Colliers is a local real estate firm here. Actually, it's national, one of the largest national real estate firms in the country, but they've got a very large office here. And they had a program where they talked about this proprietary Nashville Growth Index. I'll show you in a moment, but they put together a number of different metrics into this index, including local and regional budgets, rent escalations, job growth, GDP, market sentiment, investments, vacancies, population growth, and they put together this index and took it back to basically 2001, and it's specific to Nashville. And what that index shows is that the Nashville economy it's like a long-term growth stock chart that Abby and Andy, I'm sure, can talk to you about it ad nauseum. But what this is showing is that the Nashville economy has grown consistently, or the long-term trend has been very good since 2001, with some dips during some pretty challenging times, including the recession in 2008, the Nashville flood, COVID. You see pullbacks, but the resilience of the Nashville market has been very good, and I think that will continue, which will be good for all of us. And if you look at a little more specifically, the metrics of this economy relative to the U.S. look very good, both for this year and then projected going forward. So you can see the numbers, the U.S. or the national growth rate for GDP, employment, population, spending, and housing is the top number, and then below that you see the growth number. In almost every instance, our growth rate exceeds that of the U.S. in the aggregate. So, I think I'm just confirming, or these numbers confirm what we all know, that it's a great time to be in Nashville, to be an entrepreneur in Nashville, quite frankly, be a banker in Nashville. And what does that mean from a banking standpoint? This is the last slide, but I just thought I'd give you a perspective of what these higher interest rates mean from both a borrowing standpoint, but also from a deposit standpoint. At the end of the day, banking is a pretty simple business. We're taking in deposits, which make up basically our raw materials. That's what we lend out. And the money or the margin we make is the spread between what we charge in interest and what we pay for those deposits. So right now, you've got, borrowing and debt in general is more expensive. If you have a line of credit or a home equity line of credit, that is on a variable rate and it's typically tied to prime. Right now, prime is 5.5%, and it's 3.25% in January of this year. So it's gone up pretty substantially, which I don't have to tell you. If you look at your monthly statement every month that shows your interest charges, you would know that. Mortgages, in turn, have gone up substantially. Still, I hear the whole adage, historically speaking, they're still relatively low, but I think the shock of the increase, the speed of the increase has been the shock to the system. Talking to some of my colleagues in our mortgage group, mortgage originations, definitely from a refi standpoint, but also from a first purchase standpoint, are significantly down because of that quick increase in rates. And right now, if you're looking to borrow, for a loan to purchase a building or to purchase a piece of equipment, as a business owner, you're looking at fixed rates of the mid to high fives for 5 or 7 years. 10 years, that's even higher, assuming your bank offers that. So borrowing costs have gone up. But the flip side of that is if you have deposits in our bank or any bank, you're getting paid more for deposits. And right now, deposits of significant balances, you should expect to get a rate of 1% plus on those deposits, assuming it's in a money market, which is really a savings vehicle where we can apply that interest. And then our bank and almost any other bank right now, our focus is deposits. Banking also, while it's a simple business, but it's also schizophrenic in some cases. In other words, 6 months ago, our focus was loans, 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 loans. We were flushed with deposits. And when I say we, I mean banking in general. Every bank had more deposits they knew what to do with. That has changed over the last 6 months as loan demand has increased, as deposits and people spend down the deposits they had because of COVID and other things. So now banks are really struggling to get the deposits they need to accommodate the loan growth. So because of that, that means we're willing to pay more. So I'll stop there. I don't want to take up any more. I think we're a little bit over on our time. And Samara, I don't know if we have time for one or two questions, or should we give it over to Abby and Andy?
Why don't we go to Abby and Andy, and then we'll cover the
Okay.
questions at the end. Is that good?
That's fine. Great. I will stop my share assuming I can. Yep.
Andy, you're muted. I'll jump in first while he's getting our slides pulled up. I'm Abby Spalding. Andy and I are business partners. We own Continuum Planning Partners. We're a local firm, but have presence in other markets as well. Quick humble brag, we just got nominated for the Next Up Awards. So if you know anybody on the board, you better nudge them to see if we can hopefully win that category. We are going to talk specifically a little bit, kind of dovetail on Mac and Kevin's presentation, and then talk specifically about where to put some money in the short term. So this is a look. We use Capital Group on this example. It's a really kind of a look at why we shouldn't necessarily fear a down market. Down markets come with a lot of uncertainty, especially if you're trying to buy a house, trying to expand your business, trying to make sure that you're not getting too far out in front of your skis. This here's a look at GDP growth, and it goes back all the way to 1950. You can see it stops right there at 2020. So we're not looking at where we currently are. That is when COVID was hitting. So you can see there's just a tiny downturn. But on average, a recession lasts about 11 months. And on average, the GDP goes down close to 2%. Versus right afterwards, an expansion is typically 69 months. And the GDP growth on the backside of it is close to 25%. And as you can see, there will always be down markets. There'll always be downturns in GDP, but they're typically followed by a very strong economy. There's a lot of debate, and whether it's correct or not, it doesn't really matter. But there's a little bit of debate saying that the recession started in 2020, and that with COVID and COVID relief and all the money that flooded into the economy, that it was propped up. And so you saw that pop up in 2020 and a high 2021. But if we did not have that insurgence of cash, that we necessarily would be still extending in a recession before we pop out. Andy, do you want to go to the next slide for me? This looks at return. So if we're looking at the markets themselves, again, going from 1950 to 2020, the average bear market will go down about 33%. And, earlier this year, the market was hitting those numbers, and it lasts about 14 months. Whereas on the upside, the average bull market is 72 months, and the total return is close to 280%. The other funny thing about markets is, they always say history doesn't repeat itself, but it rhymes. We're real similar to that downturn that we've had in the past. We've had high inflation before. We've had rising interest rates before. We've had conflict with Russia before. And again, looking backwards, knowing that we've also had it in the same market of a midterm election, which midterm elections tend to put quite a bit of pressure on the market as well. right afterwards, there's tend to be a really strong economy on the backside. So hopefully that gives you a little bit of comfort as it relates to not fearing downturn in the markets. Downturn is actually a good thing. It usually does kind of wash out some negatives that are in the market and can be really great opportunities. You know, if you're able to invest on the downside and ride up on the upside, you typically will end up ahead. This is a look at, we pulled this from JP Morgan. This goes back to 1980. And what you're looking at is what are called intra-year declines and calendar year returns. So if you look at the bars, not the dots on this chart, but the bars, that shows you where the market ended as a calendar date return. So on the whole, you can see there's a lot more up than down. But what's interesting, if you look at those red dots, the dots are what happened within that same year. So you can see that 2008 year, we went down almost 49% in the depths of the recession of 2008. Now, if you look at the following year, that year we ended 23% up, but that year hit a negative 28. So markets are going to move quite a bit in a year. Even years that ended high, they typically do have downturns in the market. You can look at 2020, because of COVID, there was a 34% decline. And then that same year, and particularly even the year after, we ended 16 points ahead, which is a really wide spread. So again, it just goes back to show, like, yes, downturns will happen and they will definitely hurt your feelings as you put your hard-earned money away and watch it go down. But the story here is much more being comfortable in the uncomfortableness of a downturn so that you could ride it up on the upside. Andy, anything to add to that?
No, I don't think so. I'll kind of switch gears a little bit to, where should you be putting money then in this type of environment? And, with us being comprehensive financial planners, not just necessarily stockbrokers, we're going to take a look at just all the global places you could be putting money, not just the market. We want to kind of give that perspective on the market and the economy from our side. But really, if we're thinking about, a few places we can put money, there are some safe plays, and then we'll talk through some other places. There's something called Series I bonds that are out there. These are the old school Treasury bonds that your grandparents probably bought for you and stuck under the mattress. And at some point you find them and you say, oh, I forgot I even had these things. There are a lot of different types of savings bonds. The I bonds actually pay an interest rate that's tied to inflation. That's what the I stands for. So right now, I can't remember exactly what they're paying right this second, but it's somewhere in the 9% range, interest rate range that these are paying. So zero downside risk, backed by the US government, 9% return on it is not bad. Now, there are a few things you have to pay attention to. You have to keep them, I believe, for 18 months in order to actually receive the interest. As inflation goes down over time, that rate won't stay at 9% for the life of these bonds. It tracks what inflation is. But, to Mac's points earlier, we don't really see inflation dropping back down to the 2 or 3% range anytime soon. So max of $10,000 per person. So it's not like you can put your life savings in these, but, between, a married couple, children, a really good thing to put in children's name, grandchildren's name, you can find places to put some of those. You go to treasurydirect.gov in order to purchase these. There's also TIPS, which are Treasury inflation protected securities. Those are very similar to where they're Treasury bonds that pay an interest rate based on inflation. Now, TIPS trade in the bond market, and so this isn't a secret. Everybody knows about these and have flooded to them, so the price has gone up. So they're still an interesting play, but not necessarily a 9% return like you might get in the Series I bonds. They're more of kind of a diversification play with interest rates. Then kind of moving on to, liquid plays. So if I have money I want to put to work, but I want to keep it relatively liquid, where are some places that I can go? Well, you can look at municipal bonds, which pay tax-free interest. So that's you loaning money to the government to, build roads and fund infrastructure, maybe fund a giant domed stadium in downtown Nashville. Might be some bonds there. They pay a tax-free interest rate back to you. Well, certain managers use inflation swaps on those. So essentially that is a hedge against rising inflation to protect the purchasing power of those bonds. One that we're a big fan of right now is good old-fashioned blue chip dividend stocks that are paying a 3 to 4% dividend, whether the market is up, down, or sideways. The one thing we know, back to Abby's point, is 100% of the time in the history of the US stock market, it has recovered from a downturn. There has never been a time it has gone down and stayed down. So if we can put money to work in a downturn, yes, it could be down more. Yes, it's going to be really volatile, but we know we're buying at a relative low point if we're taking a long-term view. And you're going to get paid 3 to 4% to wait for it to recover. That's not a bad deal. But then we compare that with a portfolio line of credit. And so you can borrow against an investment account just like you can against your house. So if we borrow against it tax-free, we can put the money to work and let it recover. So if there's a downturn, that's when you want to put money to work. If there's a downturn, that's when there's access to good opportunities. So you borrow against it, put it to work, let the market recover, then sell, and you're being paid an income along the way. There's also things called private debt, mezzanine financing. I've heard people use the term hard money loans. These are kind of, I would call them semi-liquid. That's where you're loaning money to companies that aren't traditional bonds. So, for example, there could be companies that are too big for a bank, but not big enough to issue their own bonds, or they have a project where it's not worth going through the hassle of issuing bonds. They can do private debt, tends to be a little higher interest rate. And they're not traded in the bond market, and a little shorter terms, usually 1 to 5 year terms on those loans. On the illiquid play, one of the things that, and this Mac mentioned this as well, multifamily real estate. That's going to be an interesting play, unfortunately, because there are going to be a lot of people that can't afford to purchase homes. And so they're going to have to rent. Industrial commercial property, not necessarily office. Our office building the parking lot is pretty empty. I'm sure most of you all are as well. But shipping and Amazon and warehouse space and commercial space is going to do nothing but continue to grow and grow. And so being able to find opportunities in those places. And then finally, things that we would suggest avoiding right now. This is not forever, and this is not saying any of these things are bad, or if you have any of it, sell it all and get out. These are just kind of given where we see things in the next 6 to 12 to 18 months, or some places that might not make a ton of sense to put money. One is private equity. That's small companies, startup companies. They're going to struggle more through rising interest rates and people tightening their purses and not spending money more than your large established companies are. Individual residential real estate, primarily from a lending standpoint, individual rental homes. We found a lot of banks, and maybe Kevin can speak to this. They have a lot of individual rental homes on their books, and the interest rates that they're having to charge in order to make it worth the risk that they take on are pretty high. And it just kind of eats into the return you can get on individual real estate. Commodities and precious metals, primarily because everybody in a recession floods to those. And so buy low, sell high, right? Everybody's already kind of gone to those. They've gone up. And so it's not time to buy high. You want to buy when it's low. And then the only one on here I will say that maybe avoid forever is NFT. If anybody can explain to me why a picture of a cartoon dog is worth $1 million, then I'd be really interested to hear it, but I would probably stay away from that. And just the crypto market, in our opinion, this is pure opinion, seems to be a place that's still, even with the drop, a little bit overvalued and a lot of volatility there for the short term. So with that, Abby, anything you want to add before we open it up for questions?
Nope. Comprehensive. I know
Very
there's some
comprehensive.
questions in the chat.
There are some questions in the chat. So Colton had asked, and this was during the first batch of slides, regarding the potential slide in real estate, which actually the second batch of slides kind of covered some of this, the Nashville market relative to the broader US, but Colton asked about the potential 5 to 7% drop in Nashville home prices and was asking if anyone had a potential forecast for when that may happen and what the potential bottom of that would potentially look like from a time frame perspective.
This is Mac. I can cover some of that. I think if you look at what's going on just with the 10-year Treasury and mortgage rates, we saw when the 10-year Treasury was trading at 3.49 yield, 30-year mortgages approached 6%. Mortgage volumes went way down. Then as it came all the way back down into the 250s, we saw like a mini refinance boom. So what I would say is that, the question mark on the Fed is how much they're going to raise next year, because nobody knows that. That's in the first half of next year. If they're continuing to raise, you could see a 10-year, you're at 3 today, 3.54%, you could see mortgage rates 6.5%, 7%. So the point I'm making here is that we're only, even with the September hike, you're only 6 months into what's probably a year-long hiking process. And I think that, the pressure on housing is going to continue, especially if the unemployment rate starts to tick up. And we've already seen retail sales fall because a lot of families, I guess you can see it in the retail numbers, like at Walmart's quarter, they talked about people just buying food and gas, not going into the general merchandise section. So I think a lot of families are struggling currently with what I call high energy prices, which include electricity. And then, we get into this winter, you're going to see high natural gas prices also because there's a shortage of gas in Europe. So, I mean, I think there's just going to be, it's going to get more and more expensive to own a home. And in the short term, that'll put pressure on prices.
Can I ask a follow-up, Brandon?
Yeah, of course, please.
Follow up. So, because at least, agents and everybody right now, what they'll say is, hey, they're incentivized to obviously move houses. So, but folks will still say, hey, look, if you're thinking about buying, yada, yada. And full disclosure, I've got Pinnacle owns my entire life. The commercial building, this house, the other house, my firstborn, like you guys already have everything. So being said,
thank you very much.
You're welcome. Hey, Pete Wooten, I'm pretty sure I paid for his last vacation, I'm sure, on interest alone. So the question being, though, folks are saying, hey, 5-6%, mortgage rates. Hey, I know that seems high compared to, but historically, boy, oh boy, are they really not that high? And what I don't know, though, and just a curiosity thing for myself and refi later, what do you think 5-10 years from now, is it going to be, yeah, man, 2 and 3%? That was the glory days. We may never see it again. Or is it like, no, man, you're going to go up to 6, 7, 8, and then it's going to start going back down because 3, 4, 5% is the new normal?
Well, let me answer it this way. I guess during the pandemic, the Fed went completely all in. They shot all their arrows. They took, prior to 2008, there really was no Fed balance sheet. They've got $9 trillion in assets. 2020, which is the last year we had for data, GDP was $20.7 billion in dollars, and they've got $9 trillion in assets. So do I think that the economic performance of the U.S. going forward, because of all the deficits we have, I think Kevin took that chart out, but the deficits are about 128% of GDP, the highest by far, even above where we were in World War II. So I think growth is going to be very slow. And yes, I think the Fed will be cutting rates within a year or so. So, and I think that we will move, it'll take time, but over the next, 9 months, you'll move from a period of inflation to disinflation, not deflation, but you'll see inflation numbers continuing to go down, especially with commodity prices being pushed down by the dollar. And yeah, you could see, mortgage rates back in the 5s. That's what I'm trying to say. You could see a 10-year with a low 2 handle on it, especially, because I think when they start cutting, they're probably going to they're going to be reluctant to give back because they need arrows in their quiver to fight the next recession. But I still think they'll probably cut at least 100 basis points to try to restart the economy. So, yeah. I mean, long term, I'm fine on housing, and I think the dynamics of single family are really good, especially with the inventory shortages. But the strata of housing is such today that there's very few starter homes and there's a lot of very expensive homes. And so most people are in a boat where they can sell their house, but they have to spend another $1.5 million to get into the next house they want. And so they stay longer. And so it's sort of you're sort of in a bad place right now from a selling and buying houses standpoint. And a lot of people who don't have a house are being pushed to buy and pushed to accept higher payments than they probably want to based on rates are, and they hope they can refinance down the road.
And to dovetail on that, the Fed does not want to raise rates and leave them there. They want to get rates back down to a reasonable point, but they were essentially, I guess the best term to use is irresponsible by letting them get as low as they did. That's why we are dealing with what we're dealing with right now. So Max said it earlier, they should have started easing this a lot sooner. Instead they had to pull the emergency brake to stop the car immediately. And they're trying, and the car's moving a little too fast. So, my first mortgage was, I think I paid 5.5% for a condo I bought out in Bellevue for my starter home. And I was happy to get it. And, somewhere in the, high 3s to mid to high 4s is probably where mortgage rates should be for a good economy. And that's probably where they'll end up getting back to long term.
Excellent. Brian asked another question about interest rates. He asked, the Fed is raising rates to combat inflation, but it looks like the money supply ballooned as a result of the elimination of bank reserve requirements in 2020. Do you have any insight on why they're choosing to raise rates instead of raising bank reserve requirements, or some combination of the two?
Well, yes, the bank reserves, but you look at the banks today with the stress testing. Generally, the banks today have more are being forced to keep capital on their balance sheet, even though there was somewhat of a waiver of bank reserve requirements. And then their annual stress tests that came out of the too big to fail, which are like, we were forced, everybody during the pandemic was running excess capital, and everybody was putting up reserves for loan losses that never materialized because the Fed and in Congress sort of bailed everybody out on asset prices. But the Fed really, had they started sooner, it would have been better. But the real thing is the inflation is being driven by energy prices. Energy prices, not only gasoline, but diesel trading $1 above gasoline, higher, electricity prices, even here in Nashville, are running up almost double digits. So the Fed's really fighting energy prices, and the issue is going to be how do energy prices roll over, how persistent are they? And there's a lot of global dynamics in that, like Europe, and they have a shortage of energy. They're not mothballing nuclear plants, all that kind of stuff. But I don't know if the bank reserve requirements had as much to do with it. Really is I think that Janet Yellen, who's Jay Powell's boss, is a consummate dove. She never thought that inflation would take hold at the rate it did. And really it's on her more than Jay Powell, because she's really involved in the policy of the Fed as much as he is. I don't know if I answered that question correctly.
Do thumbs up from Brian. I have a question. We've seen the market, pretty volatile this year, and the last few weeks we've kind of been in the middle of regaining some of those. S&P is down 50 points today. Do you think we're going to retest those lows, or did we hit the bottom and things have kind of recovered? There are lots of mixed opinions. I'm just curious what you guys think.
All right, I guess I'd answer this question. Sort of coming into this year, we ended last year at roughly 25. The market peaked before year end last year at 25 times earnings. We're currently times this year's earnings, 20 times earnings, times next year's earning 18.7. Everybody thought as the Fed started tightening that earnings would fall, but earnings have actually risen. So the PE is declining, not because of the price appreciation. The market's down 11% year to date right now, and it was down to about 21, 22 at the peak downward. So the issue for next year is going to be, what are earnings? And so what's happened is that because of the zero rates, you've seen this, not only, there's another chart I didn't have in this presentation, but typically you see deterioration in household balance sheets during recessions. Well, in this past recession, the pandemic, all households and corporations refinanced their debt long. They took if they had an ARM, they went to a 30-year mortgage at 3.25% or whatever the rate was. And so household balance sheets are in better shape today than they've ever been from a net worth standpoint, because the house is worth more than they've ever been. So as far when you look forward on the market, I think the issue is going to be what are earnings as you move forward. Earnings have been rising, estimates have been rising, even though there's a lot of strategists like Mike Wilson at Morgan Stanley have been saying that they're going to fall, There's margin pressure. China is going to push down the rest of the world. So at this point, I'm pretty balanced. I mean, I managed money at Pinnacle and was the chief investment officer for 15 years. I think that the market's pretty fairly priced. And if you can see the light at the end of the tunnel on the Fed, even if the Fed pauses, that there's probably an opportunity for the market to trade higher, but not a lot higher, because it's, from a historical standpoint, it's fairly priced at 20 times current, 19 times forward. And so you'd really have to have earnings growth accelerate into next year in order to get good. And so, but the backdrop economically is pretty lousy from a GDP standpoint and all the things I covered. So I think the market's pretty fairly valued. No, I don't personally think it'll retest. I think there was a lot of fears. The Fed accelerated the tightening about how far they would go, and they've sort of, I think, rectified some of that.
Yeah, we kind of dovetail on that and agree with all of that. And we follow a lot of analysts, and the part about analysts is they're kind of like weather people and fantasy football experts. Is they're going to say anything they want. They have absolutely no repercussions if they're right or wrong. But yeah, I would agree. Our gut is, but our crystal ball is still in order with the supply chain issue. Our gut is that we won't retest those bottoms, but it's going to be a very bumpy ride and a little bit of a long recovery out of where we are now, just because of all the things that Max said. The economy is good, but not great. And so it's probably going to be a slow climb back to even, and very bumpy in between.
Yeah, what's funny about markets is it typically is not what's happening today. It's an anticipation of what's going to happen. So when the market dropped, it's because Feds were going to raise rates and inflation was on the rise. And all of that has happened. So even if they raise rates again, all of that has been baked into the market already. That's kind of the trick of the market, is it's in front of reality a little bit on some of those. So it'll be interesting to see what the midterm elections do. Markets typically also trade on greed and fear, and that might put some pressure on the market. I don't think, again, to Andy's point, this is where we think the wind's going a little bit. I don't think it'll take us all the way down to where we were in Q1 of this year. But it could be bumpy as we climb out. It's not like we're waiting on a vaccine that's going to pop the market out like it was in 2020. And you can't turn inflation off. And so that's also why it's going to take a lot longer of a climb.
Thank you so much. Are there any other questions? I think we covered the ones that had shown up in the chat here. We decided to make a quick decision and forego our breakouts for this one to leave everyone some more time to speak and for Q&A. So our format was a little bit different this morning, but I think we made the right call there. It's super interesting. Samira has dropped a link for some feedback in the chat. If everybody could take a quick minute and fill that out, it's super helpful. And with that, we will get out of here a couple of minutes early. So thanks again to our wonderful strategic alliance partners for joining us, Kevin, Mac, Andy, and Abby. We really, really appreciate your guys' time and all you do for our chapter. And thanks to everyone for tuning in and joining us. We'll see you guys next time.
Thank you.
Thanks.
Have a great weekend.
All right.
Thank you, Brandon. That was fantastic. And thanks for rolling
Yeah.
with it.
Yeah,